policy involves management of money supply and the interest rates. Monetary policy is laid down by the central bank of a country. And monetary policy involves the management of money supply and the interest rate and is used to achieve macroeconomic objectives like price stability, consumption, growth, and liquidity. The objectives of monetary policy include price stability by increasing or decreasing money supply. When the economy suffers from recession, the easy money policy or cheap money policy is pursued, whereas dear money policy is pursued during inflationary situations. Rapid economic growth is, is possible by controlling the real interest rates and the resultant impact on the investment. A cheap or easy credit policy reduces interest rates, encouraging investment levels in the economy, which in turn speeds up economic growth. Equal income distribution by making special provisions for agriculture, small-scale industries, village industries. Monetary policy ensures exchange rate stability by altering foreign exchange reserves and influencing demand for foreign exchange. Balance of payment equilibrium, that is the balance of payment surplus and balance of payment deficit. Balance of payment deficit reflects an excess money supply in the domestic economy. Objectives of monetary policy is price stability, rapid economic growth, equal income distribution, exchange rate stability, balance of payments equilibrium. Balance of payment surplus is when there is excess money supply in the domestic economy. Balance of payment deficit is when there is a shortage of money. If the monetary policy succeeds in maintaining monetary equilibrium, then balance of payment equilibrium can be achieved. The objectives of monetary policy is price stability. Price stability is ensuring balanced increase or decrease in money supply. When the economy suffers from recession, easy when the economy suffers from recession, easy or cheap money policy is pursued. When the economy is having high inflation situations, dear money policy is pursued. Instruments of monetary policy can be quantitative measures and qualitative measures. Quantitative measures are used to regulate the quantity or volume of money supply. Quantitative measures are not direct in nature. Qualitative measures are very direct. Quantitative measures are not direct measures. Qualitative instruments are direct in nature. Quantitative credit control measures or bank rate. Bank rate is the rate at which RBI lends money to the domestic banks, often in the form of very short-term loans. If RBI increases the bank rate, the volume of commercial banks borrowing from the RBI decreases. This stops the banks from further credit expansion. On the other hand, if RBI reduces the bank rate, borrowings by commercial banks would be easy and cheaper by indirectly boosting credit creation. Open market operation is the purchase and sale of short-term and long-term securities by the RBI. Whenever the RBI sells securities in the open market, the existing money supply is reduced, and the commercial banks and private individuals buy these securities in return of money. In contrast, when RBI buys the securities from commercial banks, the commercial banks will sell the securities and increase the stock of money in the economy. The cash reserve ratio is another quantitative measure. The first two quantitative measures are bank rate and open market operations. The cash reserve ratio is a specified minimum fraction of total deposits of customers which commercial banks have to hold as reserves either as cash or as deposits with the RBI. Cash reserve ratio is set by the RBI. Higher the cash reserve ratio, lower is the amount that banks will be able to use for lending and investment. Statutory liquidity ratio is a stipulated proportion of net demand and type liabilities of a bank that are required to maintain in the form of liquid assets, that is cash, gold, and unencumbered government securities, where banks earn interest on it. Repo rate is the rate at which the central bank lend money to commercial banks. Banks borrow from RBI against the government securities to meet their day-to-day requirements. Reverse repo rate is the rate at which the RBI borrows money. Reverse repo rate is the rate at which RBI borrows money from commercial banks. The difference between reverse repo rate and repo rate is called as the monetary policy corridor. The reverse repo rate is always lower than the repo rate. Operation Twist is the name given to US Federal Reserve monetary policy operation, which involves the purchase and sale of government securities to boost the economy by bringing down long-term interest rates. In India, RBI had its own version of Operation Twist in December 2019 when RBI bought 10-year government bonds of long-term nature and sold short-term government bonds in the same value. Operation Twist aims at changing the shape of the yield curve, hence the name Twist, through simultaneous buying and selling of long and short-term government bonds. The intent is to moderate high long-term interest rates in the market and bring closer them to the repo rate. Currency swap is another quantitative monetary credit control between two economies as a result of an agreement to exchange currencies with predetermined terms and conditions. India has signed currency swap agreements with several countries such as Japan, UAE. The chief objective of currency swap agreements is to get the foreign currency from, from the issuing foreign central bank at the predetermined conditions like exchange rate and volume of currency for the swap. Besides supporting the domestic currency and foreign exchange market, another main goal of foreign swap is to keep the value of foreign exchange reserves with the central bank. Currency swap agreements help in saving when the economy is not in a good shape and contribute towards stabilizing the country's balance of payment position. The long-term repo rate. Reserve Bank introduced long-term repo rate operation or LTRO to enable a better monetary policy transmission. RBI conducted long-term repo rate operations of 1 year and 3 year tenors recently. The long-term repo rate operations is expected to assure banks about the availability of durable liquidity at a reasonable cost and the prevailing market conditions. Long-term repo rate operations encourage banks to undertake maturity transformations smoothly and seamlessly. This ensures credit flows to productive sectors. Counter-cyclical fiscal policy. The Government of India adopted counter-cyclical fiscal policy to stop the economic slowdown in the country. It is a strategy adopted to counter recession or boom through fiscal measures. During recession, the counter fiscal policy reduces taxes, increases expenditure. This creates demand in the country to bring in an upswing in the country. During boom in an economy, the counter cyclical fiscal policy increases taxes and reduces public expenditure, allowing amplification of the boom can be disastrous and may increase inflation and a debt crisis. The qualitative credit control measures direct towards the quality of credit or use of credit by fixing margin requirements when the borrower borrows loan from the banks. This margin can either be increased or decreased depending on the necessary and luxury sectors. Consumer credit regulation regarding the maximum maturities of installment, credit rationing by fixing the upper limit of credit and issuing directions guidelines by RBI for to the commercial banks, that is called moral suasion, and controlling through directives. Measures of money supply. Money supply, like money demand, is the stock variable. The total stock of money in circulation among the public at a particular point of time is called money supply. The RBI publishes four alternative measures of money supply: M1, M2, M3, and M4. Recently, we have liquidity aggregates also. M1 is the currency in circulation plus the demand deposits. M2 is M1 plus saving deposits with the post office savings banks. M3 is the M1 plus net time deposits of commercial banks. M4 is M3 plus total deposits with post office savings organizations. National savings certificates are excluded. Currency in use is currency notes plus coins held by the public, and demand deposit is net demand deposits held by commercial banks. Interbank deposits are that is, the deposits by one commercial bank in another bank is not included in money supply. M1 and M2 are narrow money, while M3 and M4 are broad money. M1 is the most liquid and easiest of all transactions, while M4 is the least liquid of all. M3 is the most commonly used measure of money supply, known as aggregate monetary reserve. Liquidity adjustment facility introduced in 2000 allows the banks to borrow money from RBI to a repo agreement or repurchase agreement. The borrowings under LAF are used by banks to meet day-to-day mismatches in liquidity. The two components of LAF are repo and reverse repo rate. MSF or marginal standing facility is a window for banks to borrow from RBI in an emergency period. This raises the highest interest rate. MSF is usually higher than the repo rate. MSF rate is usually 1% above the repo rate. MSF facility came in 2011.